Good morning, everybody. I hope you're well. It is March 23rd, 2026, with a twist. I'm actually doing this very late in the evening on Sunday night because I wanted to make sure that I was covering the Asian markets in response to Trump's recent statements around what to do with Iran and the Strait of Hormuz. President Trump coming out and saying that he will target Iranian power plants. Iran responding that they will continue to target energy infrastructure and water desalination plants. And we are now moving into a much different and scarier phase. And today, my conversation with you is really to break down and explain what is happening in this system because a lot of people are still unable to make real sense of it. If we look at the current state of this market, you could see the Nikkei down 4.4% when I started to assess this. Gold price is down another 4.5%. Silver down another 5.4%. Platinum down 5%. And you know that my argument is the continuation of more monetary policy, more monetary printing, long-term inflation, right? The way that they will continue to print. That was the point of my postcard on Sunday. But what we're witnessing right now is the stress of a late systematic event. We are witnessing significant tightening in liquidity and an event where we are witnessing a place where people are selling gold for the purposes of buying oil and a stronger US dollar. And I want to highlight a couple of names that I follow. They all have different perspectives on what is happening, and I have my own opinions as well in terms of how capital and liquidity operate in financial markets. But all of them spoke this weekend, and every one of them had a very unique but very similar directional path. There's not a lot of people out there that I follow when it comes to the pathway of liquidity and making sense of it and why it matters and how capital moves across borders and when it goes home. And that's what we're going to talk about this morning because you're not going to hear this on CNBC. It's not going to be in the Wall Street Journal. The Financial Times may cover it. You're going to find it on Eurodollar University with Jeff Snyder. You're going to hear from Michael Howe over Cross Border Capital, Lynn Alden, her blog post from this weekend, her March newsletter, which is fantastic. I highly recommend it, Lynn Alden. And of course, Fundstrat. I mean, even Tom Lee's group saying you have to pay attention to what semiconductors are doing because semiconductors are what will really, in reality, lead the way. The bearish ETF this morning is down, and we're kind of watching the chop of the pre-market heading into that 8 o'clock hour. But I have a feeling that it's going to reverse pretty quickly tomorrow. We want to watch the SOXL on these key levels. That's really going to be a major focus this week. The weekend brief, as we move into this, it's supposed to be week day. Okay, we just didn't update it for March 23rd, is the Trump 48-hour ultimatum. Reopen the Hormuz or power plants get hit, Iran threatening a full closure. Futures were down. S&P 500 was down. The Dow was down. Polymarket saying that there is a 96% chance that the S&P 500 finishes Q1 negative. And of course, the Nikkei is down sharply, as are key commodities this morning. Goldman raised its Brent target to 110 through April. Saudis have it at a 180 base case. And as I noted, and Hal noted, right, this was noted in that Cross-Border Capital article from this weekend, which was exceptional. There is a very, very critical impact on global liquidity, on global capital, on refinancing, on repo markets every $10 that a barrel of oil moves higher. And if it continues to move in this direction that the Saudis are suggesting, we're just getting started. The commodity liquidations have been happening all week, and they seem to be continuing. This is not, right, speculators. This is forced, straight-up liquidation of metals. Gold, silver, copper, aluminum. And a dollar squeeze continues to build. Watch the UUP. And Freddie and Fannie placed large MBS bids over the weekend to stabilize housing finance, once again showing where the stress is in the system and that monetary policy or fiscal policy or government policy is probably going to be the only way out of this. But what will that even look like? 65.45 was the number I was looking at, Brent, at 111. The 10-year just crossed 4.4%. I can't tell you how problematic that may be. The 2-year yield pushing above 3.9. Gold fell to 44.50 and is still falling. Silver is continuing to fall. Copper hitting new lows, and the dollar is surging on the euro-dollar squeeze. The 48-hour ultimatum, Hormuz or power plants, that deadline is going to be tonight, Monday night. 48 hours from Saturday at 6:45 Eastern. Hormuz is at 5% of normal flow. That is what Goldman Sachs is estimating. Once again, I want to remind you that when the Red Sea was shut down by the Houthis, it was around a 90% decline. And there was a way to route oil and other things. It was to go around South America or South Africa, forgive me. You can't do that now. There is no way out of the Strait of Hormuz except the way in. And there is not pipeline capacity at the moment to move as much oil that goes through that choke point. 22 nations in the coalition signed Hormuz readiness statement. Options volatility is reminiscent of 2022. Traders are positioning for prolonged energy disruption, and that is, again, the key thing. Goldman's oil desk, again, 110, assuming 5% flow over 6 weeks. Trump saying he's very close to objectives. We're getting mixed signals. And the markets, of course, hate uncertainty. Now, Lynn Alden released her March newsletter, and I highly recommend you pick that up and read it. And she calls this the gradual print meeting the flywheel. The Fed balance sheet, she has said, is a slow gradual print. They're not adding $2 trillion, $3 trillion to the balance sheet to stabilize bonds like a traditional quantitative easing. They have been doing that adjustment, right? That reserve management, adding about $40 billion a month. So $120 billion have been added since December. And that's about $420 billion annualized. It ain't enough. Versus prior QE, this is obviously modest. Previous rounds have been anywhere from $600 billion to $4.8 trillion. And the big print is what she was saying. If she was going to say that there is going to be a big monetary policy change, it would be $2 trillion before she would call it big. $2 trillion. So is there a possibility that the Fed starts to increase? Possibly. She's listing Hormuz as the wild card. 20% of global oil flow moves through that. And again, that gradual expansion, 3 to 6% on a $6.5 trillion base, a quiet refill. War is the wild card that could push that gradual print into something much bigger. And that's exactly what I am highlighting. What I talked about in postcards over the weekend and what I continue to stress. They're going to print. They're going to have to. And it's going to be a relatively sizable move, in my view. I just don't know when it's going to come. And remember, we've seen instances where inflation have run significantly, and then a week later, a major central bank facing inflation, looking to try to tighten, ends up printing. And the instance of that was 2022 with the Bank of England. She's described the flywheel of chaos: war, creating debt, creating populism, creating foreign policy actions, creating more war. It's a self-reinforcing cycle, and the U.S. is deep in this pattern, and fiscal deficits will run hot regardless. That creates inflationary pressures. That also creates a lot of money potentially sloshing around. War is accelerating the cycle. A prolonged Hormuz closure cascades, talking about energy crush into more treasury selling, people needing to sell dollars, sell treasuries in order to buy oil. Oil prices continue to rise. Treasury cycle selling continues. That leads to higher bond yields. Higher bond yields leads to collateral problems. Collateral problems leads to a tightening of credit because of haircuts in the repo system. Oh, you don't understand all this? Well, that's exactly the point. They don't want you to understand it. These are the things that we talked about over the weekend. This was in my chart party. This was also in my piece that I ran on Friday. The key thing to keep in mind here is that finance changed after 2008. A lot of the things that people talk about on traditional media, they have completely forgotten the plot. It changed. It is a collateral based system now, and that collateral base is heavy US treasuries. And when yields increase, the collateral quality goes down, and that creates uncertainty. And that leads to challenges in terms of unwinding leverage. And once again, the US dollar continues to potentially rise because the whole system, particularly the euro dollar system, all that offshore capital is linked to that dollar. There is a scramble for dollars. We saw this in 2008. We saw it in 2020. And that was when the Fed had to open up swap lines to foreign central banks so that their banks had US dollars in order to finance existing debt or to effectively trade in US dollars or settle debt or settle clearance or settle anything that was the denomination of that particular debt. Isn't finance wonderful? The three pillars here are equities, commodities, and hard money and cash. That is what Alden is recommending, but focusing on high quality names, high quality companies that have earnings and are scarce. And what we might want to be looking at are companies with a high F score, very low levels of debt, and growth, right? Consistent growth in their EPS or consistent growth over time. Commodities are getting beaten up right now because of the forced liquidation, which we're going to cover in a moment. And then cash, remember, is a position. And that brings you to SGov. That brings you to a lot of these other components that, once again, cash is a position. Now, Jeff Snyder over at Eurodollar University did a phenomenal video on Saturday explaining the ongoing Eurodollar problems. The dollar is surging, and he explains in depth how the Eurodollar system operates. And it's that offshore market that most people don't talk about. The cross-border currency basis is tightening. That creates dollar funding, creating new pressure. The FX swap market's $9.5 trillion a day, and we are seeing significant demand for the U.S. dollar. Bank appetite to release and supply dollars is shrinking, and that is where you end up in these situations where all of a sudden you have a continent that is experiencing extraordinary tightening in available liquidity, and that creates a whole new set of problems. The dollar exchange rate is a quote unquote euro dollar barometer. And when it's rising, that creates funding pressure. And everyone needs dollars. We talked about this in multiple pieces, especially in Chart Party, talking about the $14 trillion in offshore credit, talking about much more on what's on those non-bank balance sheets. And cross-currency basis swaps are tightening and have been tightening all month, as Jeff points out. Bloomberg flagged that on March 3rd, noting that, yes, there was a potential rise in oil prices that was pending, but at the same time, a rise in dollar demand. And that's specifically what Hal talked about as well. Surge in demand equals plus a shrinking supply of dollars creates, this is a difficult one, according to him, the definition of deflation. Not inflation, but a deflationary pressure on the financial system. Now, Alden is saying that we have stagflationary system. He's arguing deflationary. And it's interesting because, once again, as he notes, this oil shock really creates a dollar shock. And the mechanism is that importers need billions in dollars funding to replace Gulf cargoes at new prices. So Asian firms start scrambling. Oil traders are now arranging emergency credit, and the Eurodollar system is already risk adverse before we even got into this, going back a couple of months when we started to have private credit issues and a lot of other issues at the macro level that really were not on the front page anywhere. They were buried in a couple of articles, maybe in the Financial Times, or maybe you would see a couple of things. But a lot of this stuff is really only discussed in a handful of smaller shadows. The dollar was in a low regime before March, and the paper shows basis spreads respond more strongly in low dollar regimes. This is why gold and commodities got unusually hammered, because the dollar pressure is greater than it looks. People are dumping commodities for dollars. So as he noted, everyone shouts inflation and debasement. He's arguing the Eurodollar, the monetary system, is saying, hold up, this is going in the opposite direction. Now, commodities, right? This is a liquidation. It's not selling, but gold at 4,500 and dropping now today, 3 weeks, $800 erased. Silver continuing to move lower. Copper hitting new lows. Aluminum down 8%. Worst day just happened since 2018 at the LME. Gold has selling started after midnight Eastern and kept going until 8 a.m., 5% intraday, the same pattern every single day. Silver on Thursday got whacked in the morning. Copper and aluminum, that identical pattern. This is forced liquidation to raise dollars. These are not speculators. These are not rate hikes. This is all about dollar demand. Now, I wrote about how yesterday, but I mean, if you look at and study these three voices, you're going to get a pretty good composite about what's happening in the global financial system and what's happening with a system that is under stress. Snyder's saying that we're in a deflationary dollar squeeze, that the banks won't supply dollars, that oil shock is really a dollar shock, and that we're seeing liquidation, not inflation. Now, Snyder likely falls more in the perma bear category. So you have to make sure that you understand who the messenger is, right? Tom Lee's going to be on the perma bull side, right? And even though he's kind of talking about similar things, or at least Fundstrat is, in terms of analyzing SOXS as a potential SOXS and SOXL as a potential, barometer for the markets next week. Understand where these voices sit. Michael Howe, Cross Border Capital, noting that global liquidity drives asset prices with a lag, and that liquidity is turning up, but the war could disrupt that cycle, as we noted in his piece in his piece yesterday on Sunday, and what I wrote about it extensively in the afternoon was the fact that liquidity was tightening. And what was appearing all at the same time was the collateral multiplier is under pressure. The US dollar is under pressure. Oil is under pressure. And I'm blanking on the fourth thing because why not? I've been going all day. But the four very important key inputs for the liquidity figure that he measures are all under stress and all moving in the same direction. So the possibility of a continued move to the downside on liquidity would lead to potential drive lower on equities and risk. And he said at the end of the article, we hope we're not right. Lynn Alden, in her March 2026 letter, saying a gradual print is confirmed, that war is the wild card, and her flywheel argument, debt equals war, leads to war, leads to more debt. She's arguing stagflation risk is rising sharply. Howe will argue that the road is going to obviously be toward more monetary and fiscal policy expansion in the future, and that the expansion will come from the front end of the yield curve, where the Treasury is kind of taking over in terms of from the Federal Reserve. My expectation is the Federal Reserve is going to have to take action, and Jerome Powell is probably going to have to make the most difficult decision of his career before he leaves, and that is either allow this system to unwind and you have a pure shock caused by liquidity mismatches and other issues around the globe, or you print money and you increase that balance sheet and you continue the process, which they have done time and time again, going back to 2008. All three of them see the financial system under stress. They see private credit, dollar funding, sovereign debt. They see the same fire, but they all see it from different angles. I see it from a little bit of a different angle as well. But we have to agree that the system is fragile. War accelerates every pressure, and any backstop is not guaranteed right now. The place where they differ, which is critical, I think, is that Snyder sees deflation, Alden sees inflation and stagflation, and Howe is simply saying follow the liquidity, because if the liquidity expands, well, we're probably going to see a combination of monetary inflation and price inflation, simply because we have the war and we have the monetary policy printing at the same time. And this is kind of one of the reasons in the arguments that I had yesterday, or forgive me, it is Sunday, the reason why I was arguing they need more outlets for money to flow into, which is why I think the SEC and other places are getting more creative with tools like crypto ETFs and stablecoin assets, and the Genius Act, which created a backstop and really no auction necessary for treasury bills and other assets. To show where other additional stress lives in the financial system, pay attention to the fact that Fannie and Freddie over the weekend had a sizable MBS intervention. Large bids on weekend MBS purchases. MBS spreads have been widening. Housing finance under stress. Obviously, very critical to keep an eye on this. The 10-year yield is not at 4.38. It is now at 4.4, and it probably is going to be a little bit higher by the time I wake up. KB will report earnings after the close on Monday. That is a housing signal, and we're going to get an update, hopefully, on what the expectations are. This is a signal of housing stress. And once again, we talked about where does liquidity go? Well, liquidity long flowed in the shadow banking system into MBS before the '08 crisis. And now, again, where can we get creative and put these things? One of the things I will note I think is going to be very important is not just this, watch what happens with Bitcoin. Bitcoin is kind of one of those extensions. It's one of those places where, with very little friction, money can flow. But when liquidity tightens, Bitcoin moves lower. When the liquidity cycles move to the downside, those correlate and correspond with those crypto winters that people have talked about. Rising yields and widening MBS spreads equals mortgage rates climbing, which means that housing will get more expensive. And I'm going to tell you right now, 8% ain't going to do it. This is the kind of quiet intervention that tells you that pressure is building. The week ahead, Chicago Fed Activity Index today, construction spending, KB Home after the close on Tuesday, S&P Global Flash PMI, business response to uncertainty is a key signal. Atlanta Fed GDP now update, the midweek earnings ramp up. Thursday, I'm going to watch this because I was watching Snyder's video today and I thought it was fantastic. They're doing a webinar on Eurodollar. I've never met them, never had a conversation with them, but if you want to understand what's going on with private credit and the dollar squeeze deep dive, check it out. I don't know if they're trying to sell anything, but I'm certainly interested in, trying to get a little bit of a deeper understanding of how private credit would correlate with the Eurodollar system. In addition to that, on Friday, very important, University of Michigan consumer sentiment final. S&P 5, the short and long-term inflation expectations will come out, and I'm going to tell you, this Michigan reading ain't going to be pretty. Trump, again, that 48-hour deadline expires Monday night. That is the dominant event of the week. Everything else is secondary until Hormuz or this war is resolved. Our momentum indicator is red. It is confirmed bearish. S&P 500, Qs, IWM are all sell signals. Fifth week of selling starts now. Join the Money Printer Pro to get the daily figures and break out and break down stocks. All you have to do, go to moneyprinterpro.com or just sign up in the link below. I will note that the insiders are also sending us a message. Insider buying on Friday was pathetic. There was basically nothing done. And it was pretty wild to watch because we've been watching for months and months and months some insider buying pick up, but we kind of get to these periods where we look for a possible squeeze. We look for something to cling to in this market. Insider buying is not showing us anything. In fact, insider buying is now at levels that have been brutal in the past during these sell-offs. We're still looking for something that requires a policy change. But you can see Sibane Stillwater, SBSW, good company, by the way, gold miner, silver miner, getting crushed like most other stocks in the space. The miners are getting beaten up right now. They fell under key moving averages. And I still like the miners for the long term. I still think gold and silver are going to be at very, very high levels. But we have had a negative momentum environment since January 28th. The signal went negative January 28th. Gold and silver crashed 2 days later, January 30th. And then we had the largest momentum sell-off in a couple of years, happened a week later. We had South Korea crash. And then as this war started to build up, momentum never recovered and continued to move lower. Insiders on Friday, it was just SBSW. We saw grocery outlet continued buying at the director level. Sure. AMR, which is coal, we saw a $1.5 million purchase. I am interested in that. But we are moving into late cycle environment and the possibility of a significant credit event at this point because there is no resolution in place. So once again, I remind you that cash is a position. I'm not trying to be a Debbie Downer. I'm just simply trying to point out we're in the middle of this, right? And we're looking for a way out. And we have been saying since January 28th, cash is a position. Before the war started, cash is a position. Last weekend, cash is a position. Postcards on Sunday, cash is a position. SGov, some of the other units, looking at monetary opportunities, looking at ways to what's going to step in. When is the Fed going to get involved? Who is going to get involved? The market is waiting for it. The market anticipates it. And the longer that nothing happens, the more fragile this will get. It's not the most rosy time for equity markets. And once again, as I have said, we've been largely in cash going back to February. But the reality is this: if you've listened to our insights, if you've followed what we've done, if you go back to what we saw and what happened with February of 2021 or February 2025, when we called that sell off into March and into April, the key thing here is don't spend your time thinking about this. This is my job. My job is to tell you when the conditions are likely going to improve, when the momentum is telling us that a reversal is possible, when a squeeze is likely. And it does not look like a squeeze is coming anytime soon, largely because there's no real volume to push into at the moment. The conditions looked a little bit ripe on Friday, but the way that Japan is behaving this morning, I'm a little skeptical about that. I did this tonight and filmed it tonight because I wanted to just get some sleep. There's going to be a long week. I'm just going to point it out that way. We'll see if there's a monetary policy change. We'll see if there's fiscal policy change. We'll see what Bessent and the rest of his magicians have up their sleeves. But right now, Europe looks like it's under a significant amount of pressure. Japan and Asia, other nations that require significant amount of oil, they're struggling to afford it. Japan is under pressure. It already has been under pressure. We've been warning about Japan going all the way back to late 2024 when the Nikkei crashed, its largest move down since 1987. And I remind you that their bond market is kind of joined at the hip of the U.S. bond market and that the carry trade will potentially see some pressure. The one thing that I will remind you, and this is very important to note, is in the event that interest rates continue to rise in Japan, interest rates start to rise in other places, the big problem, the number one risk that I talked about in 2026 in our annual outlook was foreign capital going home. Foreign capital going home. Investors in foreign countries that come here chasing alpha or engage in the carry trade, they put their money here. And if interest rates start to get attractive at home and they're concerned about the U.S. equity markets, they pull money from the U.S. markets, they take it home into their domestic markets. And that can have a cascading effect here in the U.S. because once again, that money leaves, that impacts the underlying price and the underlying weight in S&P 500 stocks. That carries over into the liquidity trade and it also, or forgive me, into the leverage trades, and it carries into the passive ETFs. And if certain ETFs sell off at certain thresholds, they have to start to unwind their positions. That can create forced selling. These are the types of things that we have to actually start to have conversations about. Doesn't mean they're necessarily going to 100% happen, but these are things that I have seen in 08, in 11, in 20, and in 2025. So I'm always prepared for them. I'm always looking at every scenario. And I'm not saying that a 2 to 3% scenario is going to happen. But I have to start to think about that because if that capitulation kicks in, I have to now start to actually think about what is it that I do want to own on the backside of this. And there will be a backside of this. It's going to be a difficult period, 100%. But we're going to get through this. And I will remind you that cash is a position and it is very important to protect what is yours. And that's the entire premise of what Money Printer Pro and ultimately what the capital wave before it was. It was to provide you with a signal to know risk on, risk off in this market and to give you time and conviction in order to actively manage and trade your money. So if you're not a member, come check us out. We'll be looking for the opportunity for this to go green. Again, we go back to what happened in 2025. We got the signal. Green meant go April 9th, 2025. The real signal really kicked in around April 23rd, and then we were off to the races. So if there is some big policy change or something significant happens and we see the war unwind and we start to see our signal turn toward yellow, then yes, I'm going to feel a lot better and I will start to deploy capital and I don't have to be the first person over the wall for the long term. I'm not throwing good money at bad ideas in a bad market right now. As we wrap up right now, just taking a quick look at global Forex, US dollar just continues to move higher. And that really is the key thing that we will be watching. If you want to trade the dollar, you can use the UUP. You don't need to buy 100 shares. You can simply buy at the money or in the money levels Looking at the 27 out to April. This can scream a lot higher, but use tight stops and, of course, watch what is happening. Thanks for watching. Remember, cash is a position. Me and the Money Printer is on Substack. We focus on liquidity, the Fed, what really drives markets, momentum, and insider buying. Postcards from the Edge of the World comes out once a week. We have a weekly, a second article each week, but it's largely a portfolio update. We are beating the S&P 500 this year. We are positive territory. We are focusing on companies that are choke points in the economy. And yesterday, full disclosure, we focused on ways where to put cash, to like physical cash positions. Where should you put cash right now where there is little risk in this environment? And InsiderStockBuys.com is live. Insider Buyer Report goes out each morning. Will go out this morning at 7 o'clock. I obviously posted this far earlier than usual, and that is because I filmed it on Sunday night before it was bed. I'm going to go get some sleep, and we will catch up in the morning. If you have questions, just go to the comments section, put them in, or just hit reply to this email. I prefer the comments section, to be honest. But I hope everybody has a great trading day. We'll catch up on the other side. Stay positive.